Welcome to the video. I've been away for a few weeks exploring parts of Europe, and for those of you who took the time to wish me a happy and safe trip, really wanted to say thank you for that. I also wanted to note we spent a couple of weeks in Poland, and we weren't sure what to expect, but it far exceeded our expectations. We went to 4 different cities. They all have their own unique historic offerings, and I would just say it's not on a lot of people's radar, but if you do get the chance to go there, keep it on that radar, because I think you probably have a very good time. Now, obviously, while I was gone, lots happened, but today I did want to focus on one thing in particular that speaks volumes to where we are economically. And last week, Fed Chair Jerome Powell, he delivered a speech in Philadelphia, and there's a lot to unpack from what he said. Now, on the surface, his speech was about the Federal Reserve's balance sheet. So yeah, not the most thrilling topic overall, but I want you to stick with me because this goes straight to the heart of some very, very important things: future interest rates, inflation, job growth, and then ultimately financial market stability. So in his speech, Powell walked through what the Fed has done with its balance sheet since the pandemic, where things stand now, and what might happen next. So it's pretty basic stuff, but I do have to say that buried inside all of that technical talk that he went through, there are some key signals, including a few red flags about the economy and risks to employment. I want to break it all down now, starting with the big picture. So here are the headline numbers that Powell shared during his speech. The Fed's balance sheet liabilities stand at $6.5 trillion as of October the 8th. $2.4 trillion of that is physical currency, $3 trillion is in bank reserves, and $800 billion is in the Treasury General Account. Think of that as the government's checking account. Now, on the asset side, $4.2 trillion in U.S. Treasuries, $2.1 trillion in agency mortgage-backed securities. And another key piece of information: since June of 2022, the Fed has shrunk its balance sheet by $2.2 trillion, and that's taken it from 35% of GDP down to under 22%. So that is a material reduction. It's quite significant. But even with that, Powell hinted in his speech that this drawdown may be nearing its end, and that is one of the first big signals of his speech. Now, before I go any further, let's answer this question: what is the Fed's balance sheet? A lot of people aren't up to speed on that. So the Fed's balance sheet is essentially a record of what it owns, so think assets, and what it owes, liabilities. And it is a core tool of monetary policy, especially when the Fed can't lower interest rates a whole lot further than where they are now. Think back to during the pandemic, the rates were already near zero then. So the Fed in that case turned to its balance sheet, and it bought trillions in government bonds and mortgage-backed securities to pump liquidity into the system. But the concern now is what happens when you try to unwind all of that. Let's not forget the pandemic response. When COVID hit in 2020, the financial markets nearly collapsed. We had treasury markets, usually the safest in the world. They were breaking down. And in that case, the Fed had to respond quickly. They created emergency lending programs, and they started buying securities at an historic pace. At one point, the Fed was buying $120 billion of bonds per month. Now, over that time, they added $4.6 trillion in securities to its balance sheet. Now, Powell is acknowledging that they may have held on too long. He said, with the clarity of hindsight, we could have and perhaps should have stopped asset purchases sooner. Now, that is a rare admission. He goes on to say, our real-time decisions were intended to serve as insurance against downside risks. We knew that we could unwind purchases relatively quickly once we ended them, and that is exactly what we did. But what's more important here is the rationale. They were trying to avoid a sudden market panic, and we saw that happen back in 2013 during the so-called taper tantrum. Some of you who are a little bit older and been investing for a while will remember that. The Fed chair at the time, Ben Bernanke, he sort of casually mentioned at one point that the Fed might start winding down its bond buying program. And at the time, the markets weren't prepared for that. The reaction was pretty immediate. It was pretty swift. We saw bond yields spike. We saw stocks correct. And basically, there was broad financial stress. In that case, the Fed didn't even start tapering yet, or they hadn't even started tapering yet. Just talking about it was enough to shake not only American markets, but in fact, global markets. And from that experience, it taught the Fed a hard lesson about how powerful its words can be. Ever since, it's been more cautious in signaling policy changes, which helps explain why Powell and his team sort of kept their foot on the gas longer than some economists thought was necessary during the pandemic recovery. Now, on that, he says, when we announced our taper, market participants began pricing in its effects, pulling forward the tightening in financial conditions. Stopping sooner could have made some difference, but not likely enough to fundamentally alter the trajectory of the economy. He defended continuing the asset purchases into 2021. He cited uncertainty around COVID variants. He cited concern about tightening financial conditions too early, and then the lessons from 2013 and 2018 when the markets overreacted to the idea of reducing support. He also addressed criticism around the Fed buying mortgage-backed securities during a housing boom. And there were critics who said that the purchases themselves made housing even less affordable. Powell didn't deny that, but he said the goal was broader financial easing, not tightening the housing market specifically. Still, though, even today, the concern is with us. Did the Fed overstay its welcome and fuel inflation and asset bubbles? Okay, I want to talk mechanics for just a second here. And Powell emphasized the Fed's ample reserves framework, which is how it now runs monetary policy. Now, to try and put this in plain English, the Fed keeps a large supply of bank reserves in the system. It controls interest rates using administered rates, like what it pays on those reserves. And this allows the Fed to steer short-term interest rates without needing to shrink or grow its balance sheet constantly. This framework has worked pretty well so far. We see that even while the balance sheet did shrink by that 2.2 trillion I mentioned earlier, the Fed did keep control over interest rates, but Powell did warn that liquidity conditions may be tightening, and that brings us to one of the bigger concerns, and I would say yes, a red flag. The question is, are we near a liquidity crunch? And on this, Powell hinted that the Fed might pause its runoff soon. He said, "We may approach that point in coming months, and we are closely monitoring a wide range of indicators to inform this decision." Translation there, the Fed is watching signs that reserves are getting scarcer, and that could lead to market stress like we saw in September 2019 when a sudden funding crunch sent those repo rates up like a rocket. He pointed to recent repo market pressures, and he warned against pushing too far. He said, "We aim to avoid the kind of money market strains experienced in September 2019. And like I say, this is a major red flag. If liquidity gets too tight here, the Fed might need to re-expand its balance sheet or use emergency tools again." And on that note, Powell admitted some have also argued that we could have better explained the purpose of asset purchases in real time. And this points to how clear communication is key for setting the market expectations. If people misunderstand the Fed's intentions, it may have led to another asset bubble or misallocated capital. Now, another thing to note here, the balance sheet composition is still skewed as we sit here today. The Fed's portfolio is overweight longer-term bonds, which makes it vulnerable if the rates stay high. Selling those bonds now, well, that could lock in losses and it could stress the markets. He says that the transition to a more balanced mix, more short-term holdings in this case, will be slow and predictable, but that is certainly easier said than done. Now, I want to look at Powell's economic outlook here to close things off for today. What we see is truly a balancing act. This seems to be the story all the time. He closed with a view of the broader economy and again flagged some concerns. Specifically, he talked about inflation. He noted that core PCE was 2.9% in August, slightly up, and he blames tariff-driven goods prices for that. On the labor market, he noted payroll growth is slowing, possibly due to weaker immigration and labor force participation. And he also cited job market risks. He says that hiring and layoffs are both down, and that signals a soft but less dynamic labor market. He did say that the downside risks to employment have increased. And that is particularly important because it suggests that the Fed may be nearing a more neutral or even possibly a dovish stance here. So when you look at the future outlook and scenarios, I'm going to look at 4 different scenarios here. Number 1, if inflation continues to cool. And we do see the current market pricing lines up exactly with this scenario. I'll show you here the FedWatch tool charts. They're showing strong expectations for a rate cut at the next meeting later this month and additional cuts through early 2026. And this suggests that the market believes that inflation is softening and the Fed will respond with easing. Now, the second scenario is if inflation holds steady at around that 3%. This is more of a wait-and-see stance, and the uncertainty in the January charts you see here reflects that. There is certainly no consensus beyond early 2026. The market is cautiously optimistic, but not fully confident. Of course, you can see that with the nearly 50-50 split for the rate projections on January 2026. Now, third scenario, if liquidity tightens too fast, and this isn't reflected directly in the charts, but the aggressive pricing of cuts could be interpreted as the market anticipating financial stress. Think things like a slowdown, liquidity issues, employment softening. And in this case, Powell did warn signs of tightening liquidity. If that escalates, the Fed could intervene, not just with cuts, but with balance sheet tools like repo facilities that aren't priced into these charts, but are definitely worth watching. Now, the fourth scenario, if inflation spikes, and this scenario is currently being completely discounted by the markets. There are 0% probability of rate hikes at any of the upcoming meetings. So this tells us that the markets believe inflation is under control or falling, and the Fed is done hiking. Now, my final thoughts, like I said at the beginning here, is this speech wasn't a very fiery one. It wasn't full of big headline news, but it was full of these signals. His tone was cautious, careful, subtly concerned. Sounds like he's preparing the markets for the idea that the balance sheet runoff might stop soon and the liquidity management is becoming a higher priority. He also acknowledged past missteps. Rare, we see that. He did signal flexibility on future policy. He warned that both inflation and unemployment carry risks right now. I'm interested in what your take is. Drop your thoughts in the comments below. I would love to hear how you're reading the situation. As always, I say thank you for watching, and we'll see you in the next video.